It's time now for our weekly strategy session, and in the hot seat today we've got Chris Meyer, CEO of RMB Morgan Stanley. Thanks so much for joining us today, Chris. Well, can you believe the first half of the year done and dusted, and with that, comes all of these quarterly reviews where the market has lost about 0.6% for the past quarter. On a half-year basis, what kind of performance are we looking at?
I think the market was about flat for the 6 months. So, I think it was very difficult for investors to make money the 6 months, whether you're a retail investor and you've gone long the market and your money's done nothing, or whether you're a professional investor, which is most of our clients, and trying to spot a trend, even in a flat market. Very difficult. And
that's exactly it, because I was speaking to Ntombendle Radebe at Nedbank, and we were just looking on a day basis, but even over the period, there's been no definable trend.
That's right. Yeah, I think there was a little bit of resources over financial and industrial stocks in the first couple of months of the year, but then you gave it all back by March. And then in the last 2 or 3 months, it's the financial and industrial sector that's outperformed the resources. So if you got cute and got your timing right, you may have made some money on that basis. But I think if you look at resources, let's say you were bullish resources and you decided to buy Impala Platinum, you could have lost 20%. But if you'd bought Exxaro, you could have made 30%. So it was really a stock picker's market. Even in the banking sector, which is normally a very homogeneously priced sector, I think Nedbank was up 12% for the 6 months. Standard Bank was down 7%. A very unusual sort of move between two counters in the same sector. So tough to make some money, I think, if you're a professional investor.
So what's your approach to the markets at the moment where we've got this trend line that's just so hard to identify?
Yeah, we actually think we think it'll remain a stock picker's market, okay? So as the world's economic recovery remains reasonably uncertain, we don't think investors are going to take a big statement and either short the market or go long the market to any great degree. So they are going to be looking for specific opportunities. Having said that, we actually do think that some of the dispersion in the local market that's happened, dispersion meaning similar stocks haven't behaved like each other, might actually moderate or come together, therefore some mean reversion in the second half of this year.
We've had some proposals being put forward that you've actually got to plot out what your bottom share price is and the top, look at things on that basis and operate under that kind of regime.
Yep, I think it's kind of we call it a trading range. It's kind of a trading range driven market, and I would look for a little bit of mean reversion in the second half. So maybe Standard Bank plays a bit of catch up to Nedbank, maybe Anglo American or Impala plays a bit of catch up to Exxaro, that kind of thing is probably what I would be looking for in the second half of the year.
Of course, taking into consideration the state of the global economy and where exactly we're at, what's your overall view on where the markets or how the markets are poised right now?
Yeah, if you look at our strategists, and we've got many of them, but if you look at probably the two most important global markets that we look at, the US and emerging markets, they're both at the moment saying be a bit careful of equities. The US guy is saying it because he thinks earnings expectations for US companies are too high, so they need to moderate. And until that happens, he thinks the market's expensive. And then Jonathan Garner, who's our emerging market strategist, is saying China's raising rates. This is a problem for equity investors. Wait until they've stopped raising rates, i.e. the second half of the year or probably even the fourth quarter, and then invest in equities. So tactically we're saying sit on the sidelines, but wait for probably the fourth quarter to get more aggressive again on the long side.
Of course, where caution is the key word here. I mean, a phrase that has been used time in and time out at the desk this week has been the fact that all we're doing with the various mechanisms is having kicked the can further down the road, especially if you're looking at the situation in Greece at this stage. Do you share that kind of sentiment?
Yeah, so I think Greece now, there's a little bit more clarity, and that's one of the main reasons I think why we've had a couple of strong days here. I think for me, the more important issue is equity markets are correlated to earnings growth over time and therefore to economic growth, and I think that's the main uncertainty, particularly in developed markets, that people are focused on. So today's Institute for Supply Management number, the ISM number in the US, is a very key indication of whether this weakness we saw in May in that number, it was the biggest miss in the ISM in May that we've seen since Lehman Brothers went bust. If that miss versus expectations in May can correct itself in June, because May was really just the impact from the Japanese earthquake, and so some of the supply chain constraints that came from that, or whether it really is the world is slowing and the US is slowing a little bit fundamentally.
How do you mix the noise from the relevant data? Because we see a slew of economic data filtered through, and it pretty much comes in as a mixed bag, and you cannot go, you know, on the basis of looking at those economic data points on a month-on-month basis to make your investment decision.
It's a good question, and it's difficult at times, particularly when there is no direction. We do two things. One is we do fundamental analysis on markets and companies, so we try and get a feel for what we would regard as intrinsic value. So what is the asset really worth away from any noise and trading pattern in the stock? And the second thing we would do is we would talk to market participants. So we would try and to some extent that's where the noise comes from. But if you want to see what the market views of some of the data noise that comes out, get a feel from the market as to what they would interpret a good or a bad number to be. And then you know when the data comes out whether it's likely to be a positive or a negative reaction by the market.
Now, interesting commentary coming out of Morgan Stanley yesterday, where you've initiated your coverage of the Nigerian economic landscape, and you're very positive about the potential of Nigeria. Run us through that and your focus on Nigeria specifically on the continent.
Yeah, sure. No, it was a very interesting piece. I think it's called On a Growth Charge or something like that. It almost feels too bullish. But I'll walk you through it, and I think there's an interesting debate to be had as to whether our view on the economy is being felt by the markets. Because if you look at the Nigerian market, there's not that much going on there. No. There's not that much M&A activity. There's not that much volume in the stock market.
Because everyone's waiting for that banking sector resolution to come in hard and fast.
That's right, yeah. And so maybe that's one of the things they're waiting on before people put their money into that market, or corporates, you know, go and buy companies in that market. But anyway, so we're saying we think that Nigeria could grow 8.5% this year and next year. I mean, those are staggering GDP growth rates. You know, we're starting to talk about China, India, Turkey type of growth rates, which is great news for Africa, frankly, if they can do that, because South Africa has always been constrained at the kind of 3 to 5% range. So anyway, 8.5% I think is above consensus, so that's got people's attention. And we think it's going to be driven by the kind of non-oil part of the market. So, you know, people think Nigeria, oil, so if oil price goes up, Nigeria does well. We actually think that things like telcos, construction, retail is going to be the part of the market or the economy that drives the GDP growth rates to that extent.
Of course, when we speak to our brokers on that end as well, clear and strong emphasis being placed on the fast-moving consumer goods sector, simply because of the growth potential it boasts, given that consumer market that's there. Yeah,
that's right. I mean, we looked at a few things. So on that point, people think big population must be able to sell a lot of food. Okay, it's quite simple, but actually we look at the minimum wages. They've just bumped up minimum wage from I think 7,000 to 18,000 naira. Big change, okay? Money in the consumer's wallet. They're likely to pass the petroleum bill this year. That will have a big impact on infrastructure spend. Okay, they've set up a sovereign wealth fund to put infrastructure investments in. That could have a positive impact. This AMCON to save the bank. So there's a few specific self-help things that they're also looking at, as well as just the fact that the penetration of consumerism in a 150 million person economy is very low.